Unit 1, Income Tax Gross Income, Lecture 3, Gross Income, Capital versus Revenue. Gross Income, Capital versus Revenue. Gross income only consists of income received by an individual, but is income in nature. Any amount of a capital nature does not get included in gross income, as it will be subject to the rules and rates of capital gains tax. Only once a taxable capital gain amount has been calculated will it form part of a taxable income framework. It's also important to note that capital income in the hands of one person may be non-capital in the hands of another. As a general rule, any amount received by means of trade, business, or personal effort is not capital in nature. Sometimes it may be difficult to establish whether an amount is in fact income or capital in nature, as it all depends on the purpose and on what grounds the amount was received. If a person sells a car and makes a 50,000 rand profit, that will be capital in nature. However, if it's a person's trade or regular business to sell vehicles, then such amounts will be income in nature. The subjective and objective tests may be used to determine the nature of such amounts. The subjective test focuses on the intention of a taxpayer at the time of acquisition of an asset. Was the intention to sell the asset for income purposes or to keep the asset for personal use? The objective test applies the following principles: the manner of the acquisition, the period for which the asset was held, the pattern and occupation of a taxpayer, and all of these can make one determine the nature of the income. Whether an asset is regarded as income or capital, it has important tax consequences. For a capital amount, the maximum tax rate is 18%, for income is 45%. If Kagiso bought a property for 1 million rand to live in permanently, and later sold the property for 2 million rand, will it be regarded as income or capital? Since it was not the intention to purchase the property as trading stock, the process will be capital in nature. Therefore, it is important to distinguish between whether an asset was purchased as an investment and or for private purposes, or whether it was a speculative purchase, of which in the latter case the process will be included in gross income. Although the Income Tax Act gives little guidance as to whether an amount is income or capital, in the case of shares it is more specific. Section 9C of the Act states that if a taxpayer disposes of shares held for 3 years or longer, any proceeds from such a sale will be capital in nature and CGT rules will apply. This is applicable to listed and unlisted shares. The meaning of receipt or accrual. Receipt means a physical receipt that the taxpayer actually receives for his benefit. Accrual, on the other hand, means the amount is still to be included, even though it was not actually received by the taxpayer. For example, Anne sells furniture for cash during the current year of assessment. She also delivered the furniture on 25 February, but only received payment on 30th of March. Determine the date of accrual. Although Anne did not receive the amount during the 2018 year of assessment, she fulfilled all the obligations of the transaction and was entitled to the funds as the client owes her the money. The proceeds will be included in her 2018 year of assessment.